Hi, I'm Brant Spessart, president of Steward Wealth Strategies, and thank you so much for tuning in for our Q4 2023 economic review and our 2024 outlook. On behalf of your wealth manager and all the great folks here at Steward Wealth Strategies, I just want to say I hope this message finds you well, staying warm, and having a great start to the new year. You've heard us say it before, but knowledge is power. This is why we continue to communicate with you, our client, because we know as we try to be good stewards, making wise decisions comes from knowledge. And one of our jobs as stewards to our clients, as well as providing advice, is to help you be more knowledgeable so that you can make good decisions that are in your best interest for you and your family's financial future. So, economic markets experienced a great fourth quarter. The S&P was up and the Dow was up as far as Q4 was concerned. We saw tremendous growth. And if you think about it, it was kind of difficult last year. At the beginning of last year, we just wrapped up 2022, which was the worst year in the stock market since 2008. A lot of analysts and economists at the beginning of the year were talking about recession and tough times to come. But for those of you that were patient and focused on the long term and held on, you were rewarded. Because over the course of the year, we saw a lot of volatility that tested a lot of investors. Just look at the first 3 quarters of last year, up and down along the way, but then we had that strong Q4. Now, last year, inflation was a concern, and it's still a concern. Inflation numbers have come in a lot less, but a lot of us are still feeling the significant rate increases or the inflation increases that we've had over the past couple of years, especially when we go grocery shopping or out to eat or just buying goods and services in general. But inflation has slowed down, and that is primarily a result of the Fed's raising interest rates. Remember, we talked about this last year, but the Federal Reserve had the most significant, the most rapid rate increase in decades. We went from almost 0% interest rates to the Fed funds rate being in the 5 to 5.5% range. We saw a lot of increases last year, but we didn't see as many as we did in 2022. 2022 was really significant, but last year we still saw rate increases, but they slowed down. And then all of a sudden in Q4 last year, they held steady. Now, we have 8 more opportunities where the Fed meets this year to possibly raise rates or to possibly lower rates or keep them the same. Now, the Fed did announce at the end of last year they're going to possibly lower rates 3 times this year. And that's really kind of helped spur some of this economic growth we've seen, whether it's in the housing market or it's in the stock market or just the economy as a whole. But for conservative investors, when rates were going up, conservative investments like bonds went down in value. So conservative investors felt a lot of volatility along with more aggressive investors back in 2022. Last year, conservative investors still had some volatility because rates did go up. Even though they were a slower pace, they still went up last year. But this year, if there are rate cuts, it could be a decent year for bond investments. Now, a lot of our clients are more growth oriented, focused on the long term, but just to inform you and update you, there is a correlation. When interest rates generally go up, bond prices go down, but when interest rates go down, bond prices typically go up. Now, you have to understand with interest rates that the yield curve doesn't necessarily make sense. Most of us would think, hey, the longer I'm going to lock in a conservative investment like a bond or something like that, I'm probably going to get a higher interest rate. Well, last year, interest rates were higher for shorter term, lower for longer term. Now, at the end of 2023, rates are higher for really long-term holdings than they are for shorter term. However, just know it's not perfectly linear though. Because if you look at this chart right here, December 29th, the 20-year is actually is actually higher than the 30-year. Now, safety. The good news is when rates went up, a lot of us that have emergency funds that are, Dave Ramsey followers, and we have our 3 to 6 month emergency fund, or maybe somebody who's more concerned, they have 12, 24 months emergency fund. Cash was actually earning something. In fact, the national average for CDs as of the end of the year was about 2%. At the beginning of last year, it was a little over 1%. A lot of us, though, are seeing, hey, look, we can still see CDs out there paying 4 to 5% if you shop around. If you have questions or are interested in something like that, hey, talk to your bank, reach out to us. We could possibly help with something like that as well. But the good news is for savers, you're at least getting paid on the cash that you have. And I don't know if you've ever heard the saying, but economists exist to make weathermen look good. A lot of economists and analysts were talking about how awful 2023 was going to be. They were predicting the stock market to drop. They were predicting recessions. But here's the thing. Now it looks like it's going to be a little bit more of a soft landing than a severe recession. That is good news. None of us like the R word. It invokes a lot of fear in people and really kind of brings back the thoughts of the 07 to 09 era. So the good news is the economy is a little bit better and the recovery is a little easier than what was anticipated. But last year and this year, there's still a lot of geopolitical concern. China, the war in Ukraine, what's going on in the Middle East. There's always been concerns globally with conflict. And last year, that held true. And this year, that's going to hold true as well. But remember, when it comes to investing, the way you win with equities, it really is a long-term approach. You've got to be cautious. Don't put all your eggs in one basket. Be diversified. Use good investments. Don't gamble. Don't day trade. But make sure that you have a plan. One of our roles here at Steward Wealth Strategies is not just helping clients with financial plan, but it's making sure that you're in good investments. But good investments go up and down along the way. You've probably heard us say this before, but volatility is the price we pay for long-term growth. If we don't want any volatility, then we're probably looking at bank products like CDs and so forth, those interest rates. But if we want the growth like 2023 had, and we want the historical growth of the market, we've got to be willing to deal with the ups and downs. But we understand that it's difficult, especially when you're close to or in retirement. It's even more difficult because a lot of retirees go from being a saver to a spender, dipping into their nest egg, and it can get a lot more uncomfortable when you're going through times of volatility. So reach out to your wealth manager or our team here at Steward Wealth so that we can talk through options, make sure that, hey, you are still in the appropriate investment mix. It's still in your best interest, or is there a better strategy for where you're at this particular stage? So here's the thing. Inflation is slowing down, but it's still a concern. Inflation, we're not in a time period of deflation. Prices aren't going down. It's just the rate of increase is slowing down. So everything that became expensive a few years ago is still expensive. It's just not going up at the same pace. There could be some rate cuts this year. Hopefully there are, for those of you going out to, to buy a home or whatnot and need to take out a mortgage. Hey, lower rates will be extremely beneficial for you. Volatility remains. But I'll give you an investment tip. Volatility always remains. Even in good times, there's volatility. But the good news is the recession that was being predicted, we're actually going to, now they're saying, hey, look, it's going to be a lot softer. And that's great. We still have low unemployment. If interest rates ease and maybe go down, that'll be great for the economy as a whole. But stay the course. This year, we're all going to experience a lot of negative headlines. It's a political year. It's an election year. And we all know what that's going to hold in store for us. Put your faith in God and not in your political leaders, but just know that there's going to be a lot of commentary, a lot of negativity out there, but try to focus on your objectives and your goals. Talk to us about the plan and the strategy. And sometimes the strategy may not necessarily be what we want to hear. January last year, after we went through this awful time period in the stock market, a lot of people said, hey, look, why are you not telling us to pull all our money out? Well, the right thing to do to achieve these long-term goals is to ride it out sometimes. If we're in good investments and we've got the right strategy that's in your best interest, sometimes the hardest thing to do is to focus on what you've been doing. But be prepared. The Scout motto, be prepared. Take a proactive approach versus reactive. Try to stay level-headed and reach out to us if we can help you at all. Many of you honored us last year with a lot of introductions to other folks that may or may not have become clients. Thank you so much. We're honored to be able to serve you. We're super blessed because of you. And if you do introduce somebody to our firm, thank you so much. We really appreciate it. If it's somebody we can add to this webinar distribution, or maybe they can attend one of our in-person events, that would be fantastic right there. But again, on behalf of Steward Wealth Strategies, thank you for being part of our family. And I hope that you and your family have a wonderful 2024, and there's more to come. Thank you all very much.